All right, welcome to this explainer. We are diving straight into why these are, quite frankly, truly abnormal times. We're talking about what's being called the everything rally. We're about to unpack one of the most massive, contradictory phases the global economy has ever seen. We're going to look closely at the data to understand why everything, and I mean absolutely everything, is testing all-time highs right now and what that actually means for your future. Okay, let's dive into this. As an investor, a trader, or really just anyone trying to make sense of the financial landscape today, you've got to ask yourself one fundamental question. What exactly is going on in the global markets? What has changed under the surface to cause everything to test all-time highs all at once? I mean, seasoned pros are staring at their screens right now, scratching their heads, because the traditional rules of economic gravity, they just don't seem to apply anymore. Because when you dig into the underlying data, you see this glaring paradox. We've got our traditional safe havens like gold and silver hitting new highs practically every other day. Usually, these are the assets people flock to when they're terrified and just want to protect their wealth. But then at the exact same time, the risky assets, the stock markets, the crypto market, they're also making massive new records. Historically speaking, polar opposite asset classes don't win at the exact same time. It's a massive contradiction. You typically have a risk-on environment or a risk-off environment, right? Never both. And the mystery deepens even further. Global bond yields are currently sitting right at peak levels. This is happening globally, including right here in the USA, and remarkably, it's happening despite central bank rate cuts. Normally, when you hear about rate cuts, you'd expect bond yields to drop in tandem, but assets are just defying traditional economic gravity across the board, which tells us we have to look deeper for a completely different root cause. So what is the hidden math behind these skyrocketing asset prices? That brings us to the denominator effect. Think of asset pricing as a giant, simple fraction. When you're pricing an asset, whether it's gold, represented as XAU/USD, or the S&P 500, represented as SPX/USD, the asset itself is your top number. That's your numerator. But the US dollar is the bottom number. It's the denominator. And right now, the critical realization driving this whole global trend is that the US dollar, the denominator for most major global assets, is actually what's declining. Now, what's really interesting about this is the context of that dollar decline. The US dollar index, the DXY, has been steadily falling, and this drop is happening despite immense global war pressures. Usually, geopolitical conflicts act like a massive magnet, sending global investors running to the safety of the dollar and driving its value way up. But that just isn't happening this time. And when the currency you use to measure the value of your assets is inherently losing its own value, it creates this powerful illusion of massive, across-the-board asset gain. And this brilliantly illustrates the exact dynamic playing out in the markets right now. When you have the perceived value of the asset pushing upward and the US dollar dropping down, you don't just get a mild linear increase. You create an explosive multiplier effect. It just skyrockets. That little mathematical quirk is the hidden engine powering this entire everything rally. Which brings us to the next vital piece of the puzzle, a contradictory economy. The US economy looks strong officially, on paper, but we're entering its most contradictory phase ever. Consider the specific catalysts driving this. Right now, the Federal Reserve wants to restart the rate-cutting cycle. On the political front, you have figures like Kevin Warsh facing pressure from Donald Trump to cut rates. And the primary justification they are lining up to allow for these cuts, they're pointing the finger at a highly weaker labor market. Objectively speaking, we can see exactly how these political and central bank pressures are aligning. They're all pushing aggressively toward a lower interest rate environment, completely regardless of the strong facade of the broader economy. But pushing for those cuts introduces a massive underlying danger. Let's move to the rate cut paradox. Let's see how this builds because it's a very direct chain reaction. Step 1, central banks and political pressures succeed in forcing lower interest rates. Step 2, those lower, cheaper interest rates artificially encourage a massive surge in spending and borrowing by both consumers and corporations. Step 3, injecting all that new spending and borrowing into an environment that is already testing all-time highs ends up doing one very dangerous thing. It fuels inflation all over again. And that chain reaction leads us to the ultimate consequence of this economic paradox, the recipe for stagflation. Let's be crystal clear on what this actually means, because if you're trying to navigate the coming months, this definition is absolutely crucial. Stagflation is a vicious, structurally damaging economic cycle. It's characterized by painfully slow economic growth combined with a high unemployment rate. But the real kicker? that economic stagnation is accompanied by high inflation. It is effectively the worst of all possible worlds for everyday consumers and investors alike. So, the crucial point is, this is a literal math equation for an economic storm. When you take high inflation, reignited by those paradoxical rate cuts, and you add slowing economic growth, and then factor in the rising unemployment that officials are using as an excuse to cut those rates in the first place, you get the perfect, undeniable recipe for stagflation. The pieces are just locking right into place. Which leaves us with one final, deeply important question to consider as we wrap up this explainer. Are you positioned for the everything rally to become stagflation? We've just seen how a falling denominator creates the illusion of massive wealth, and how contradictory pressures to aggressively cut rates might just set the stage for severe inflation right alongside a weakening labor market. As we navigate these truly abnormal times, understanding the hidden mechanics behind these all-time highs isn't just interesting, it's essential for protecting your future. Think about how this data impacts your worldview and your own financial strategy. Thank you so much for diving into the numbers with me today.